April 1, 2026. No press release. No White House statement. No Fed announcement. Just one line inserted quietly into the Treasury's publicly posted auction calendar on March 28. GLDI. Gold-linked discount instrument. The silence wasn't oversight, it was operational discipline. Ensuring execution preceded interpretation. Because this wasn't another T-bill. It was the first note in a parallel dollar system launched on, indexed to, excluded under, and opened for all effective April 1, the first business day after the 78-day 2025 debt ceiling crisis expired at midnight March 31. 4 co-occurring, non-negotiable features activated simultaneously, not phased, not piloted, not conditional. First, launch date April 1, timed precisely as markets absorbed March 12 ths. On target, CPI print plus 0.3% MOM with zero movement asterisk in the 10-year TIPS yield. 1.87% right pointing arrow 1.87%. Normally, CPI moves yields plus or minus 12 basis points. This time, silence. Second, LBMA indexing daily principal adjustments tied exclusively to the LBMA gold price PM fix at 3:00 p.m. GMT. Set by 5 major bullion banks, audited daily, used. In 95% of physical gold settlement a real-time, apolitical reference variable, not CPI, not PCE, not any U.S. government statistic. Third, debt ceiling exclusion per OM Circular A11, Section 4.2, C, GLDI is structurally omitted from statutory debt limit calculations. Meaning every $1 billion in GLDI issued adds $1 billion in usable fiscal headroom without a single vote. Fourth, Foreign Eligibility Prospectus Section 2.1, B, states, non-U.S. official institutions may participate without FRB Regulation K approval, subject to LBMA Global Precious Metals Code compliance. No gatekeeping period. Confirmed by Treasury's April 2026 allocation report. $42 billion in confirmed foreign central bank bids, more than 5 times the $8.2 billion average quarterly foreign official T-bill demand in Q4 2025, led by PBOC, SARB, and the BIS. These weren't isolated quirks. They were hardwired infrastructure deployed without ceremony because their purpose was operational, not rhetorical. While markets treated CPI as noise, Treasury activated its CPI-exempt channel. That's not symbolism. That's a system update. The GLDI T-bill isn't a gold play, it's the first official admission that CPI has ceased to function as a binding constraint on U.S. sovereign financing, replaced by LBMA gold as a real-time, apolitical reference variable for dollar-denominated debt. So how does this new infrastructure actually run? It runs like this: hardwired, rule-based, and entirely automatic, not discretionary policy, but executable code. Per the official GLDI prospectus, Section 3.2, principal adjustments shall be calculated daily using the LBMA gold price PM fix, effective immediately upon publication. That's not aspirational language. It's an instruction set, and it activates every single business day at 3:00 p.m. GMT, the exact moment the LBMA publishes its official afternoon gold fix. At that instant, no human intervention ever. Treasury systems ingest the LBMA feed, calculate the new principal amount, and update the ledger, all within 60 seconds. The face value repaid at maturity shifts dollar for dollar with gold's LBMA fix. No smoothing, no lag, no discretion. No committee meets. No analyst interprets. No override exists because the system has no human interface, only API endpoints and cryptographic verification. Settlement follows the identical T-bill structure. Same maturity schedule. Same legal form under 31 U.S.C. Section 3105. Same tax treatment, only the principal formula differs. Critically, it settles T plus O. Same day value date, processed via Fedwire by 6:00 p.m. ET. So a central bank in Tokyo can bid at 11 a.m. local time and settle before markets close. No time zone arbitrage, no settlement risk, just certainty. Eligibility is enforced automatically too. Prospectus Section 2.1, B, states, non-U.S. official institutions may participate without FRB Regulation K approval, subject to LBMA Global Precious Metals Code compliance. That mandates live trade reporting and verified custody, no paperwork. Treasury's automated eligibility gate validates each institution against live LBMA registry data before auction, no manual review. And every adjustment is auditable. ISO 8601 timestamps, SHA-256 hashes of the LBMA JSON payload, cross-checked against the official debt ceiling exemption registry, all logged to a public, tamper-proof ledger, accessible to any participating institution. On April 2, 2026, the LBMA fix rose 0.8%. Treasury Systems updated $1 billion in GLDI principal by $8 million at 15 hours 0 minutes and 1 second GMT. The A11 exclusion flag triggered instantly. Settlement. Processed same second, all logged, all verifiable. This is production infrastructure deployed, tested, and operating under live market conditions since April 1 and stress tested across 3 volatility spikes in its first week. While CPI takes 30 days to compile, GLDI recalculates every 24 hours using data published within seconds of LBMA's auction. So when you see CPI unchanged on your screen at 8:30 a.m. ET, GLDI's principal for that day was locked in at 3:00 p.m. GMT, 12 hours earlier in London, by gold, not inflation. Its operation requires no reference to CPI data whatsoever. Full stop. Now that we know how GLDI runs, let's see how markets responded when it launched. Because its mechanics were automatic, its market impact was immediate. On March 12, 2026, the Bureau of Labor Statistics released CPI, plus 0.3% month-over-month, exactly at consensus. Textbook, on target. Under normal conditions, that print would have moved the 10-year TIPS yield by plus or minus 12 basis points, of predictable, calibrated reaction. Instead, it held steady at 1.87%. Not a dip, not a rally. Flat, zero movement. That silence wasn't indifference. It was confirmation. Markets treated CPI not as a signal but as noise. A lagging artifact. A statistic compiled 30 days too late, calibrated to a basket of goods increasingly disconnected from sovereign funding realities. While CPI sat still, GLDI moved. The first GLDI auction closed on April 2, just 3 business days after that CPI release. It drew a bid-to-cover ratio of 3.8x. Highest since 2008, and $42 billion in confirmed bids, all from foreign central banks. Not hedge funds, not ETFs, central banks, institutions whose sole mandate is preserving reserve value, allocating capital away from CPI-indexed instruments and into a gold-linked, CPI-exempt instrument in real time. This wasn't correlation, it was causation written in Treasury's own auction results. And it was statistically validated. Reuters Macro's 2026 analysis, published in February, before the GLDI launch, found no significant evidence of a link between inflation factors and gold. Not weak, not delayed, no significant evidence. Which means CPI isn't just failing to move gold prices, it's functionally irrelevant to the very variable now indexing US sovereign debt. So let's be precise, CPI hasn't been challenged. It hasn't been debated. It has been retired, not by pundits, not by politicians, but by the Treasury's own operational choices in Q1 2026. When the 78-day debt ceiling crisis ended on March 31, the Treasury didn't wait for Congress to act. It activated a parallel channel, one that bypasses CPI-based valuation, congressional debt limits, and Fed gatekeeping, all in one line on an auction calendar. And markets didn't hesitate. They voted with $42 billion for the new reference variable. CPI's quiet retirement wasn't announced. It was executed, and its replacement is already live. LBMA Gold Real-Time, apolitical, and now the official reference variable for dollar-denominated debt. It's not symbolic. It's not experimental. It's not for hedge funds, ETFs, or retail traders. This is where the parallel dollar system stops being theoretical and becomes operational fact. Because on April 12, 2026, just 11 days after the first GLDI auction, the U.S. Treasury published its official allocation report. And it named names. The People's Bank of China allocated $12.40 billion to GLDI in April, its largest single-dollar instrument purchase outside U.S. Treasuries since 2020. Not bonds, not notes, not tips. A gold-indexed, CPI-exempt T-bill settled same day, held in USD, and excluded from every debt ceiling calculation Congress has ever passed. That wasn't a portfolio tweak. That was a structural recalibration. South Africa's Reserve Bank SARB followed with $3.70 billion. The Bank for International Settlements, the central bank of central banks, committed $2.10 billion. And those are just the ones publicly disclosed. According to Treasury's April report, 8 additional foreign official institutions participated under confidentiality clauses, all meeting LBMA's Global Precious Metals Code, all bypassing Fed Regulation K entirely. Why? Because these institutions don't hold dollars for yield. They hold them for sovereign stability. And in Q1 2026, they faced a clear choice. Keep allocating to CPI-indexed instruments whose valuations had just gone silent, or move into a new channel where the reference variable is updated daily, audited hourly, and governed by 5 London bullion banks, not Washington statisticians. Reuters Macro's 2026 analysis had already confirmed the math. No significant evidence of a link between inflation factors and gold. So when CPI prints stopped moving markets and GLDI demand spiked, it wasn't coincidence. It was convergence, a new valuation regime, validated by real capital. And make no mistake, this isn't diversification away from the dollar. It's diversification within the dollar, separating dollar exposure from CPI risk for the first time in history. At a moment when official gold reserves surpassed U.S. Treasury holdings for the first time in 30 years, and when the 78-day debt ceiling crisis exposed the fragility of congressional fiscal limits, the Treasury didn't wait for reform. It launched infrastructure. GLDI isn't a gold play. It's the first official admission that CPI has ceased to function as a binding constraint on U.S. sovereign financing, replaced by LBMA gold as a real-time, apolitical reference variable for dollar-denominated debt.